All right, everyone. Tonight's webinar is going to be a really important one to watch. Tonight's webinar is basically the basis. It's kind of the fundamentals of really everything we do as traders. This webinar should be a why to everything. It's kind of that fundamental and foundation. I'm going to talk about something called the invisible hand. Maybe you've heard about it. Maybe you haven't. I'm going to talk about how it relates to the stock market. I'm going to talk about what that even is. If you're ever doing anything, if you're ever about to buy a stock for, some pattern, maybe it's a breakout, or you're going to short a stock, and it's a breakdown, or you're playing overreaction, et cetera, et cetera. All of those decisions come off of this very basic fundamental idea that I'm going to talk about in this webinar. Okay. And you may not even realize it. It's almost like a subconscious thing. But as you start to look into this a little more, this will give you a very important why into everything you do as a trader. So before I get started, I do want to talk briefly about captax.com, which is our we have got a CPA who's amazing to do everyone's taxes for cheap. That's the honest truth, and his results are incredible. It's as if you went to a top tier elite private firm. You're getting the same type of service. So get a free quote from us at captax.com. Really, they do a great job. Okay, so let's dive into things here a little bit more. So this is going to sound really elementary here, but stick through this with me, okay? Because I kind of need to build up to things, okay? Every time you buy a stock, someone is selling it to you, right? Every time you buy a stock, the seller of that stock thinks you're dumb for buying the stock, okay? And vice versa. Every time you sell a stock, there's a buyer on that other side of the transaction that thinks you're dumb for selling your stock. They think they have an edge on you. They think they're smarter than you. They think they're making the right trade. It's the exact opposite of you. Okay, day trading, in this sense, in a way, is a zero-sum game, which means if you made $1 today, it's because someone else in the day trading world lost $1 today. Now, investing, if we're talking long-term investing, that's not the case, right? It's not a zero-sum game. Markets are a place to build wealth, grow in retirement. That's a separate thing. But in terms of day trading, it's a zero-sum game. If you ever have a green day, it's because you literally went out and took that money from someone else. You were smarter than someone else that day, and you took that money from someone, right? Okay, and again, I know it's a little bit elementary, but it's important to understand this, right? You're not just buying shares from thin air. There's a seller, whether it's a person like you sitting at their desk at home, or it's a computer algorithm selling these shares to you, or it's a giant hedge fund, who knows, or it's Warren Buffett himself, who knows, okay? There is someone on the other side of every trade you take. So you need to ask yourself, if I'm buying this and someone's selling me these shares of this stock, what's their argument? What are they trying to do here? What are they saying that maybe I'm not? And could they be right? And it's important that you keep an open mind. And I talk about this a lot. You need to have a bullish argument and a bearish argument in your head at all times. If you're ever buying a stock and you're buying it thinking it's going to go up and you can't think of one bearish reason why anyone would sell it to you, then you're blindsided and you need to look a little bit harder, because there's always going to be a reason, right? There's always going to be an argument somewhere. But whoever wins that argument, whether it's the bull or the bear, that's the side of the trade you should take. It's the direction of the trade you should take, okay? So what I want to talk about next here is this idea known as factored into price, okay? And that's this idea that everything out there in the world, okay? Let's talk about Apple for a second. Every piece of information that's public out there in the world is factored into the current stock price, okay? So whether they're going to make a new iPhone, whether they're selling tons of iPhones, whether they're not selling a lot of iPhones, it's all factored into the price. So if Apple's trading at $150, there's a reason for that. It's not just some BS number. There's a reason for that. The overall markets have consumed, they've considered, they've digested all the news, all the public information out there, and they have created this price for Apple at $150, okay? This, of course, is why insider trading is so terribly, incredibly illegal, because they have info that isn't factored in by the markets. So again, let's talk about Apple trading at $150. Well, if you're Tim Cook, or as President Trump would say, if you're Tim Apple, and you know that in 2 hours you're going to release a contract saying that Samsung is, who knows? Let's say you release some big contract with Samsung, or you're going to buy out Samsung. It's going to make your stock price jump by 200% or something, and you act on that. That's called insider trading. It's illegal, right? Because that information is not factored into the price, and that's why the stock jumps, of course, when that becomes public. So anyways, the point is, when a company releases news and when you're preparing to trade it, you need to ask yourself, Is this already known? Companies will do that frequently. Okay, they'll release like an SEC filing and then not PR about it until 2 days later, and everyone thinks, oh, they just announced this news this morning. Okay, yeah, but the smart money actually knew about it 2 days ago because they actually read SEC filings. Okay, now it doesn't happen a lot. They're usually paired together pretty closely, but it's just an example there. This is just, it's one of those things where like people will be like, this company had this huge earnings beat, 100% growth in revenues, everything's amazing. Why is the stock going down? We have to consider maybe the market had already factored in for them to release earnings and have a huge, a huge beat in revenues. So let me move through a little bit quicker here. As I talked about this, I've actually talked about this in a previous video. What I want to talk about next is the invisible hand. Okay, by definition, the invisible hand is an unobservable market force that helps the demand and supply of goods in a free market to reach equilibrium automatically. Okay. Now, there's some big words in there. If you didn't take any econ classes in college or high school, you may not know what those words mean. But in the simple way to put it, it's basically how the price of anything is created. You go to the store, you buy an apple, costs you $1. Why? Well, the invisible hand basically made it cost $1. It took into consideration every single farmer out there in the world selling apples. It took into consideration every person out in the world buying apples, and it said this is the fair value of an apple. It's the same way with stocks. That's how the price of a stock is created. Why does Amazon trade at $1,600 a share? Why does Chipotle trade at $500 a share? Why does Apple trade at $150, et cetera, et cetera? The price of these stocks are created based on this basic supply and demand, aka the invisible hand. Now, some people may disagree with the invisible hand, and there's arguments for everything, but it's just a basic, simple idea. Okay, the invisible hand creates the price of everything. So you take a look at gas prices. Think of everything that changes in the world of gas prices. Today, gas filled up for $2.10 a gallon. Well, 2 weeks from now, I could fill up and it may cost me $3.10 a gallon. That's because depending on the supply and demand of oil, the invisible hand is going to find a fair value of that gas that it's going to cost you to put in your car. Okay, so in summary, the invisible hand here, these are the factors that go into it. Okay, the invisible hand plays an important role, again, in fairness and equality. And as long as the government or as long as some third party stays out of it, the invisible hand will fairly create a price, that's fair for buyers and sellers. But when you get government or, some sort of regulation or restrictions to enter into the markets, it restricts the invisible hand from doing basically what it should. And that's when things, sometimes don't get fair. And this is a very, like I said, this is a point of view that some may disagree with. But in terms of free markets and capitalism, it's kind of somewhat of a generally accepted idea that this is how free markets and capitalism work. And the less government involvement, the better, right? That's kind of the basic understanding. The less involvement, the better. Free markets the invisible hand can just naturally decide the price of stocks, decide the price of the steak you're going to eat for dinner tonight, et cetera, et cetera. Okay? And you could get into subsidies and all that stuff, farming this, farming that, and how it all plays a role into things. So this is just a little chart again, take you back to econ. Okay, take you back to your college econ 101 class. The supply and demand of anything, whether it's stocks, whether it's apples like we talked about, whether it's cars, whether it's homes, the basic supply and demand will decide the fair value price of that item, whatever it is. Okay, and that's why we talk about low float stocks a lot. Ask yourself, how would low float stocks play a role in this? Well, what are low float stocks short of? Supply. That's why they're low float. There's not a lot of shares out there. Supply is very low. So if there's any perk in demand for that stock, that's why the price shoots up insanely high, because there's just really very little supply. Okay, so let's continue on. I want to talk about homes for a second. Okay, you go out, you put your home on the market for $400,000. You say, yeah, this is a good price. I feel good about this price. I'm going to post it. You're not an expert, right? Maybe you are. But for the most part, you're just a person trying to sell your home. And maybe you get some help. Your realtor suggests this, someone else suggests that. You decide to list your home for $400,000. Well, then all of a sudden you get some offers coming in way above your asking price, between $420,000 and $430,000. In this case, the invisible hand protects you basically from your own negligence, and it gets you a fair value, a fair price for your home. Even though you list at 400, people are bidding over the top of it because they know, oh, this is undervalued. There's probably other people bidding here. I'm going to bid higher. All right. Now, what I want to talk about next is the appraisal. Okay. You might think, what the heck does it have to do with stocks? But this is just an example of how kind of third parties and regulation can screw with free markets and capitalism, et cetera. And an appraisal, you might list your house for $400,000. You might go under contract to sell your house for $430,000. But then an appraiser comes along and says your house is only worth $175,000, right? Okay, that's an extreme example. But guess what? You're going to have a real hard time selling your house for much more than $175,000 because no one's going to be able to get a loan for more than $175,000. You say that's total bogus. Again, that was an extreme example, but appraisals really, it can get messy. How this all is just an example, right? The point is that appraisal is coming in and messing with the market. So now you as a seller aren't protected. The invisible hand isn't protecting you. The buyer is trying to get away with a screaming deal, but the deal is probably just not going to happen at all because you're going to say, that's bogus. I'm not going to sell my house for that little. And so no one wins when this happens, when there's this intervention. And I'm going to talk a little more how about this applies to the stock market. Okay, so hang tight with me. Next, I want to talk about outliers. Now, some of you may be familiar with this term outliers. Some of you may have read the book called Outliers. If you haven't, I would strongly recommend that you put it on your reading list. It's called Outliers. It's just really a mind-blowing book. It makes you think about things in a lot of different ways. But there's always going to be an outlier to everything. Okay, everything you do, to every rule, there's always going to be an exception. There's always an outlier. An outlier basically means it's the one that doesn't follow the rules. It's the one that doesn't do what it's supposed to do, et cetera, et cetera. So when you think of athletes, you take a look at LeBron James or Michael Jordan. They were outliers. They were just way above and beyond anyone else. And you can apply this to a lot of things in life. You take a look at Steve Jobs. He was an outlier. He did things that normal humans don't do. Jeff Bezos, he's an outlier. He's doing things that normal people don't do, okay? Our job as day traders is to find outliers within the stock market and profit off of them, okay? Again, read the book Outliers if you haven't yet. It's a great book. Love it. Okay, so moving on, keep this in mind here about outliers, okay? Again, an outlier is something that doesn't do what everyone else kind of thinks it's going to do or what it will do or what it should do, I guess. Well, folks, now that we've talked about this invisible hand and things, we've talked about how stocks love to find their fair market value based off of public information and all this stuff. So now where the heck is our advantage? Why would we have any advantage at all if that's the case? Well, it comes down in a large part to why we as day traders focus on trading catalyst. Catalyst is an event that causes a stock price to jump. Okay, this is new information that suddenly hits the market. Okay, so let's say you go to the store to buy an apple one day, it costs you $1. Well, then let's say that night, 90% of the apple orchards in the world burn down. Guess how much apples are going to be the next day? A lot more, because that's a catalyst that changed the price in apples. Same thing with stocks. There's catalysts that change the price of stocks based off of the news, sometimes good, sometimes bad. Now, it takes the invisible hand some time to figure out what the fair price is. So going back to my apple example, let's say 90% of the apple orchards burn down in the world. The next day, you're going to go to the store, apples, it's going to cost you $35 an apple. The next day you go to the store, it's going to cost you $45 an apple. The next day you go to the store, it's going to cost you $22 an apple. It's going to be all over the place for a while. And that's because people are trying to figure out, okay, with all these apple orchards burning down, what now we have to figure out, right? The invisible hand, the market's supply and demand have to now kind of recalculate. And that takes time. For certain things, it takes years and years. For other things, it takes seconds, okay? And this is where we slide in as day traders. We look for those things that we feel is an outlier based off of the catalyst, okay? So here's an example. Go back to our apple example. 90% of the apple orchards burned down in the world, okay? The next day, people are talking about on the news, oh, apple orchards burnt down. It's not that big of a deal. They'll be back next year. Not that big of a deal, okay? So apples are like $20 an apple. Well, let's say you're like, no, I think this is a big deal. This is a really big deal. And instead, you buy every possible apple you can for $20, and then 2 days later, you sell them all for $60 an apple. Okay, I know this is kind of a bad idea. It's kind of messy. I hope you're following along. But the point is, it takes time for people to figure out what news matters, what news doesn't matter, how it is going to affect this, how it's going to affect that. It's very rarely an instant thing. And this is why we so frequently focus on post-earnings plays. Okay, I would say 99 out of 100 stocks that I trade on a day-to-day basis, I'm trading because they have a catalyst. Maybe even 100 out of 100 stocks, honestly. Okay, day traders, really your only advantage is within catalyst. And there's lots of catalysts, news events, earnings, even breakouts. That can technically be a catalyst, and I'm going to explain why that's a catalyst. But there's always something propelling it. You never just randomly look at a stock and say, I'm going to randomly buy this and hope it goes up. You won't be a successful trader if that's the case. Okay, so anyways, let's go back to this earnings play here. Okay, I want to talk about earnings here for a second and how this is a catalyst that we so frequently trade. This is Roku here, okay? Let me make sure you can see my little mouse here. Laser pointer. Okay, this is Roku. Now notice how tightly it traded here. I mean, it's actually a pretty good movement for a larger cap stock like this. But just notice that it's trading pretty tight here. But guess what happens? We get earnings to come out on this day, and it starts to get a little bit more volatile as we head into earnings. And then finally, earnings drop on this day, and look what happens. It drops by like, what, $3? No, like $8. It drops by like $8 initially and immediately rebounds. We talk a lot about how when earnings releases come out, the first reaction is almost always wrong, and it will often flip from being up huge to down huge within a matter of like 30 seconds. It's unbelievable. And you say, why in the world did that happen? Well, it takes time for markets to digest the news. It takes time for the invisible hand to do its work and say, these earnings are good. These earnings are good. Here's the demand for this stock. Here's the supply. These are the amount of sellers. These are the amount of buyers. And it slowly finds its price. So you'll see here, it kind of found a little bit of a price after these earnings. But guess what happened at market open the next day? A giant rip from Roku because markets still hadn't figured it out, right? If markets knew immediately what was going to happen, then this stock would have immediately gapped up to here and just traded sideways, right? It would just totally traded sideways. But it doesn't work that way. It takes time. It takes sometimes a lot of time. Like in this case with earnings, look at the volatility that followed the earnings release and look how many opportunities there were to profit and trade from it if you were on the right side. So in the example of this being an outlier, the first outlier that we could have found was a stock selling off $8. Now, if you were lucky enough, and I would never try to do this, but if you happen to like just buy this dip super luckily and then it bounced up, great, you're lucky. But like I said, that's luck. Now, if you actually have time to consider things and say, these are the earnings numbers, this is this, this is this, this is this, this wasn't expected, maybe it should have been expected, etc., and you actually bought this dip intentionally because you felt this was an outlier, look how much that you would have profited from it. Okay. Now, the next day, 2 days later, it sells off. And if you found that sell-off being an outlier, saying this shouldn't be selling off like this is an outlier, this is a rare case here, with how good those earnings are, with what markets are doing, this is going to continue to trend up. Well, here's another great buying opportunity for you and to close on this day and a great swing, right? And look at the continued momentum upside. And you know what else happened is Amazon, they released news about Amazon Alexa, and look what continues. It just continues the volatility. And that's what we love as day traders, because within volatility, that's where the outliers sleep. Okay, that's where the outliers lie. That's where opportunity lies, is within volatility. There's no volatility, we have no chance. We have no chance to be profitable. Okay, and that's why we love catalyst. And that's why if I ever trade a stock, it's so important. So important to know what the recent catalyst is. And it doesn't mean the catalyst had to be that morning. It could have been 6 months ago, but it's still affecting the stock. Okay, it could have been a year ago. I mean, take a look at Amazon, what they've done. Their catalyst of basically taking over the internet is still in play, and it's been moving for the last 4 years. And in a sense, if you kind of widen your range a little bit, that's a catalyst. And Amazon, in a lot of ways, to a lot of people, is still an outlier, and that's why so many people still did buy it. Then, of course, you get to the point of, okay, if so many people think it's an outlier, is it really an outlier at this point? And then it's not. And then the stock drops from 2,100 down to 1,400 because too many people thought it was a sure thing. Right? Because I could go on, but I'm trying to keep this a little bit more simple here. Okay. Here's another example. This is a stock, super low float. Remember when I talked about low floats? This is 80 cents. This is $1.90. That's a 100% move in seconds. 100% move in seconds because they release news. Boom! But guess what? People totally overdid it. And so if you were smart enough to say, wow, this is totally completely overdone, and you happen to short this, this is an outlier opportunity to short here and make a lot of money. And then look what happens again. They release another news event, boom, a huge shock in the price, right? And many people shorted this. They thought this is bogus, this is this, right? I hope you would have more of a reason to short this than just saying it's bogus, but you get my point. People felt that this was an overdone move and short it and were able to capitalize on it. But this opportunity isn't there if the volatility isn't there. This volatility has to be there in order for us to have opportunity, both long and short, okay? And that is why it's so important for us to develop a system. And what I mean by that system is it's going to be different for everyone, but you have to find things that are working and not working. You have to find catalysts that are consistently overreacting, like this one. You have to find catalysts that get totally overdone initially so that you can short them. And then you have to find catalysts that totally get overdone to the downside, like on our friend Roku here, and enter that to the long side. Now, easier said than done, right? Of course, right? I doubt anyone you'll never trade anything perfectly, but this is just the general ideas. Is that we're looking for overreactions, underreactions. We're looking for things that are different. We're looking for patterns that repeat themselves. Okay, and it's all because of the invisible hand. I'm going to go back to the invisible hand. The invisible hand is trying to find a stabilizing fair value for every stock out there on the stock market. But sometimes us traders and computer algorithms, et cetera, kind of throw that off a little bit, and then the stock price then becomes an outlying stock price. And then we want to take advantage of it, whether that's the long or to the short side. Okay, so then enters. Well, first, let me just talk about this for a second. One of the best examples of finding these overreactions that I trade probably every single day, and every single one of you has probably traded with me, and you just may not really realize it. But what are we doing when we dip buy earnings winners and when we short earnings misses that have strength? Let me show you what I mean by that. This is a dip buy of an earnings winners play. Okay, this is DLTR. We traded this so textbook, I just absolutely love it. So first of all, earnings get released right here in after hours, and guess what? Initially drops, then goes up, then comes down, then drops, right? That's the volatility I'm talking about to begin with. This is very hard volatility to trade, okay? Don't trade this initial volatility. I mean, if you're very experienced and you get really familiar and comfortable with it, then okay, maybe do a small size, but most people don't really try to trade this volatility. The majority of this is computer algorithms freaking out, trying to figure out what to do, okay? Trying to digest the action and just figure out what the heck's going on. And then finally it finds its peak here, and then we got what we so consistently get. So many people woke up the next morning to these massive profits in DLTR because the stock jumped from 95 up to 101. That's a 7% gain on your money, and if you add $200,000 in the stock, you're going to be very pleased about that. So you take your profits. You take your profits. You take your profits. Lots of people take their profits. Lots of people take their profits. And now we get to this point where it's overdone. And then I come in, ideally, with an alert that says, all right, this is overdone. This is now an outlier. Let's dip buy. This is where we dip buy. We're going to dip buy because everyone else is panicking, thinking this is going red. Now, there's so much more into it, right? What were the numbers? And, of course, that's where the experience of knowing when to dip buy and how to dip buy things enters. But the idea is that we are playing an outlier here. And we traded this off of a gap fill. A gap fill is when the stock gaps up in a major way and then comes back all the way to where it was before the gap, just like this, and then it bounces. It's an incredible pattern. It's an incredible pattern that makes us a lot of money on a consistent basis. Okay? The reason why we made money on this was because we were smarter than most of the people out there in the stock market who were taking their profits and selling. We took advantage. We were outliers in the fact that we succeeded. Okay? Every time you make a winning trade, you are one of the few. You're one of like the 5%, 10% that's actually successful in the markets every time you make a winning trade. Every time you make a losing trade, you join the 90%. Okay, 10% of people who make money in the stock market, they're still in the rest of the 90%. Okay, so this is a really good example of overreaction that became an outlier that we took advantage of and made money off of. Okay, now I want to talk about something else that's really important to consider, and this idea is momentum. I want to talk about momentum versus the invisible hand. Okay. So if this invisible hand thing is a real deal, why do stocks move at all until news comes out, right? Why don't stocks just trade sideways for months at a time until they release earnings and it immediately jumps up or immediately jumps down? Or Why don't they just trade completely sideways until a news release comes out and then it immediately jumps up to the price that the invisible hand deems is fair and deems as its value and then just goes sideways again? Well, that's because of this idea of momentum. Okay. And now momentum is created by us, by you and me. We create momentum. And let's say you're really smart and you design this computer algorithm that becomes the best computer algorithm in the world, and your computer algorithm trades billions and billions of dollars on a daily basis. Well, guess what? You still created the algorithm. Yes, it's computer trading, but you created it. You told the computer what to do, right? So this idea of momentum, this is where it falls into our hands. We create momentum. Okay, we create liquidity in the markets because we're constantly buying and selling, thinking we have an edge, thinking, right? It's people thinking that they have found an outlier that sometimes will spark momentum. And it's people thinking that this is the top or this is the bottom and entering and exiting. This is why stocks flow, even though the invisible hand does a pretty good job at keeping the price stable for the most part until a new catalyst comes along. All right, so it does take time, all right, for the invisible hand to figure out its thing, and momentum while it's trying to figure out, the fair value of a price, the fair price of a stock. It's going to take some time, and that's where momentum and volatility is where we enter and capitalize on, and are able to make money. Now, I do want to talk about trading halts because trading halts, in a way, are the invisible hand at work. They pause the stock from trading, and then it opens up and it will gap down or gap up. So even though it does gap and move immediately, there's always volatility that proceeds. And that's why we often trade stocks coming out of halts as well. Okay. So I mentioned this already a little bit here, but we create momentum within the stock market. Okay. A bull flag, this is like one of the more common stock trading ideas here. A bull flag. A bull flag is only a bull flag because we deem it to be so. Okay. We feel that a bull flag is important, and we trade bull flags as they break out. Like, look at this breakout the next morning and continuation. That's the only thing that gives a bull flag strength. There's nothing magical about a bull flag, guys. There's not some like hidden potion that lies within these stock ticker candles and things. There's nothing special and magical that lies within it. But because you and me and the people before us and the people before them felt that stocks basically tend to break out as they reach certain levels and as they do things off of patterns, that's what gives us follow through. We create these patterns. We give these patterns validity. Okay? And I'm going to explain a little bit why that's a good and a bad thing. Okay? History tends to repeat itself, right? And it's just like, it's this, why does everyone drive on the right side of the road? Right? Well, how did that start? How did that begin? I don't know. Someone decided to do it, and it became a law, and now we all do it, right? Like, why do bull flags break out? Because who knows how long ago, when day trading became a thing, people found this as a pattern. They found that this stock tended to do this frequently, and then they started to trade it. The more they traded it, the more it happened, and the more the people followed, the more it happened, et cetera, et cetera. Okay? That's us. We're just trading each other. Okay? Now, I will say there's a little bit of a twist to that. Okay, patterns change, and patterns only work for so long, and they're constantly working and not working, and they'll come back and work again. Right? Bull flags could be amazing today; they could be terrible tomorrow. Right? Typically, though, they will work for kind of these rushes of time. 3-4 days, groups of time. Then another pattern will be super strong for a week, and then another pattern will be strong for a week. Okay, and the reason for this is, let me give you an example here. One of the most basic common patterns is to buy a stock up and over its high of day. Okay, super basic, common, very, very basic, right? Now, this can be a great pattern when it's working, if it's in, right? And I know that's obviously, that's kind of a dumb thing to say, but hopefully it'll make sense in a second. Because once high of day breakouts start working, and they keep working, and everyone starts buying high of day breakouts and making money off of them, well, guess what happens? Someone out there says, you know what I'm going to do? I'm going to buy 5 cents before the breakout so that I can make 5 cents more on this trade. Because when it gets so close to that high day breakout, everyone's anticipating the high day breakout. Everyone buys it anyways and it makes money. Well, why don't I make 5 more cents by buying a little early? So one person does that one day. The next day, 100 people do that. The next day, 10,000 people do that. And now all of a sudden, breakouts completely lose their momentum because there's no one waiting there to buy over high of day anymore because everyone's trying to get in early. So then what happens? Well, then people start to short any high of day breakouts because they're so terribly weak. And guess what? High of day breakouts now, instead of being bullish, high of day breakouts are now incredibly bearish. All because of us humans constantly react to each other. We are the ones that make patterns work and not work. Okay? We are the ones that change that. That's why we have to constantly be on our toes, constantly looking for what is working and what is not working, constantly looking for an edge, constantly looking for an outlier. We have to have a good understanding of catalysts and how they affect the stocks, because the better understanding we have of catalysts, the better understanding we have of the invisible hand. If a stock releases good earnings and it drops 90%, guess what I'm going to do? I'm probably going to buy it because I have a pretty good understanding of the invisible hand that that's an overreaction. Okay? And the more you see these catalysts, the more you experience them, the better idea you will have of overreactions and how to trade them, how to trade these overreactions. Will you be perfect all the time? Absolutely not. In fact, you will probably be wrong maybe even half the time. But as long as your risk to reward ratio is in the right place, you can be a successful trader by being wrong half the time. You can actually think about it. If you're a baseball player and your batting average is 350, that means you're getting on base 35% of the time. Okay? That means you're getting out way more than you're getting on base, but you're a successful baseball player. Now, obviously, that's just how that's baseball. It's different. But my point is, you can be a baseball player. You can bat 350 in the stock markets as long as your risk to reward is there. As long as every time you win, you're making a lot more than you're losing because you're managing your risk to reward tightly. Okay. The point is, this is where experience comes in. You need to befriend the invisible hand. Because the better idea that you have of the invisible hand and how the invisible hand wants to price certain news events and certain catalysts, the better idea you will have to be able to trade the outlier, the overreaction, the underreaction. So tomorrow morning when you wake up to trade and you have a stock doing something, anything, you need to ask yourself, is this an overreaction? Is this an underreaction? Where does the invisible hand want to take this stock to? Now, next to it, you have to ask yourself is, okay, I think I know what the invisible hand wants to do. Now, what do the other humans want to do? How are they going to trade this, right? Are bull flags working today, right? Let me go back to this example here, okay? Are bull flags working here today? And does that breakout of a bull flag, does that kind of fit my opinion that this stock is undervalued? Because if they do, if bull flags are working, and if my opinion that on the earnings release of this stock, whatever it was, that this is undervalued and that the fair value of the stock should be much higher, then you have an A+ setup. That's an A+ setup, right? Basically, the invisible hand, maybe you feel this should be at, maybe you feel the stock should be at $200, it's only at $71. If you genuinely feel that for some reason you have that type of an edge over everyone else, then you should buy this and put this in your long-term portfolio, right? If it's only at $70, you feel it should be at $200 because for some reason you think it's undervalued, and if you think you're that smart and you have this, much of an upper hand on other people, then that's what you should be doing, because that's an A+ setup for you. Okay. Now, again, there's a lot of theory that I'm talking about here. There's there's a lot of ideas I'm throwing around. Okay. And I just hope that you can digest it. And I hope this adds a little bit more of a why. Why in the world is this stock moving? Or why isn't it moving? Okay. This should kind of be the infrastructure of every trade you take. This is our why. We know what, right? We know we probably want to buy bull flag breakouts. That's kind of our what. We know when, all those things, but what is our why? Well, this is it. This talks about our why. And if you really kind of digest this idea and think about it thoroughly, and again, this is really brief. Right? This is really, really brief. But if you think about this idea, the more familiar you can become with it, and the more you see it happen in the stock markets, the more you'll be able to profit from and take advantage of. Okay. So I know I didn't talk about a ton of super, textbook buy over this level, buy under that level. It's more of this idea that I wanted to present to everyone to make sure that we're all familiar with. Okay. I do want to talk real quick. I made one trade today for $756. One trade. That's it. One single trade today. I sat on my computer and watched stocks all day today, and I made one trade because this was the only stock that I felt I had an advantage in. It was the only stock that I felt current market patterns gave me an advantage. It was the only stock that I felt I was smarter than the 90%. Okay? And I was fortunate I was. It's actually a really hard stock to trade today. And I would say 95% of the people that traded GLBS today probably lost money. This thing was all over the place. It went from $7 to $10 to $6 to $8 to $6 to $9. I mean, it was all over the place. And it was not easy to profit from. But that's the volatility. that provides opportunity for us to find the outliers and to then profit from. All right, so that is going to basically summarize. You can always start a free trial at kfinvesting.com. That's going to summarize my weekly webinar.